creates a responsibility. Behind every long-term liability lies evidence, accountability, and the auditor's professional judgment.
Auditing non-current liabilities goes beyond reviewing numbers. Auditors examine legal agreements, verify evidence, assess compliance, and ensure in the financial statements. Auditing is more than verifying numbers. It is about protecting trust, ensuring transparency, and strengthening confidence in financial reporting. Welcome to our presentation.
Nature of non-current liability. What is non-current liability? Non-current liability refers to the obligation due more than 1 year from the accounting period. By contrast, current liability are defined as financial obligation due within the next 12 months. These are three examples of non-current liability. Firstly, long-term debt, the portion of a company total debt with a maturity date beyond 1 year. The second will be bonds payable, the amount the company owes to the bond holders assuming the bond maturity is outside the next year. The final will be the notes payable, the amount the company owes the financier for any money lent that is due outside of the next year. B. Source document of non-current liability. Firstly, loan agreement. Legal contract signed by both parties outlining the principal amount, interest rate, repayment schedule, and maturity date. Lease contract. Document detailing the terms of long-term lease used to calculate and record non-current lease liabilities under current accounting standard like IFRS 16 or ASC 800. Mortgage deed. Legal agreement used when real estate or property act as collateral for a long-term loan.
6.2 Appropriate audit assertion and accounting treatment. Audit of assertion. First, existence and occurrence. Confirm that the non-current liabilities recorded in the balance sheet actually exist and represent liquidation obligation to creditors as of the reporting date. An example, confirm bank loan with lender. Second, completeness. Verify that all long-term obligations the company is responsible for are fully recorded. An example, ensure every long-term loan appears in the financial statement. Third, right and obligation. Ensure the company is legally responsible for repaying debt. An example, examine signed loan agreement. Fourth, accuracy. Amounts are correctly calculated. An example, recalculate accrued interest.
Accounting treatment. First, subsequent measurement. For most long-term financial liabilities, must use the amortized cost method via the effective interest method. Second, reporting and presentation. Split presentation. Any portion of a non-current liability that become due within the next 12 months must be reclassified as a current liability on a balance sheet. Third, convenience and compliance. Under accounting frameworks like IFRS, especially IAS 10, a company classifies a liability as non-current if it has the unconditional right to defer settlement for at least 12 months after the reporting period. If a company breaches a debt covenant on a or before the end of the reporting period, the liability must generally be classified as current unless the lender grant a waiver. Disclosures. Financial statements must disclose the term, condition, interest rate, maturity dates, and security pledge for each major non-current liability, as well as the schedule of maturities for the next 5 years.
Discussion on the accounting system and control activities. Account system for non-current liabilities. Initiation and authorization. Long-term borrowing or bond issuance typically require approval from the board of directors or senior management since the commitments are large and long-lasting. Loan agreement, bond indentures, and lease contracts are recorded as source document. Next one is recording. Upon receipt of funds or signing the agreement, the liability is recorded at the amount received, value of future obligation. Example, a lease liability is recorded at the present value of lease payment. Related account include the liability itself, any discount, premium, and corresponding cash or asset account. The next one is subsequent measurement. Interest expense is accrued periodically using effective interest method. Any premium or discount is amortized over the life of the instrument. Journal entries update the carrying amount each period. The next one is classification. System must correctly separate the current portion due within 12 months from the non-current portion, which require periodic reclassification and control activities for non-current liabilities. Segregation of duties, separating those who negotiate or authorize debt from those who record it and those who make repayment. Authorization controls, board resolution or senior management sign-off required of entering new long-term liabilities. Reconciliation, regular reconciliation of loan or bond schedule maintained by finance with confirmation from lender and trustees. Covenant monitoring, controls to track compliance with debt covenant, example debt to equity ratio, since violation can trigger reclassification to current liabilities or default.
Audit procedure for non-current liabilities. The objective of this audit procedure is to obtain sufficient and appropriate audit evidence to ensure that non-current liabilities are properly recorded, accurately measured, correctly classified and fully disclosed in the financial statement. First, the auditor inspect the loan agreement to verify the loan amount, interest rate, repayment terms, and any collateral provided. Next, the auditor obtains bank confirmation from the lender to confirm the existing and outstanding balance of the loan. The auditor also recalculates the interest expense to ensure that the finance costs recorded by the company are accurate. In addition, the replacement schedule is reviewed to determine whether any portion of the loan should be classified as a current liability instead of a non-current liability. The auditor also examines board meeting minutes to ensure that all borrowing have been properly approved. Finally, the auditor reviews the financial statement disclosed to ensure that the company complies with the relevant accounting standard. Audit evidence supporting assertion. Different types of audit evidence are collected to support each audit assertion. For the existing assertion, the auditor used bank confirmation and loan agreement to verify that the liabilities actually exist. For completeness, the auditor compared the general ledger, bank confirmation, and board meeting minutes to ensure that all liabilities have been recorded. For accuracy and valuation, the auditor recalculate the interest expense and review loan statement to confirm that the recorded real amounts are correct. For classification, the auditor examines the loan repayment schedule to determine whether the liability is correct classified as current or non-current. For presentation and disclose, the auditor reviews the financial statement and notes to ensure that all required information is disclosed in accordance with the relevant accounting standard. For example, if a company has a 1 million ringgit Malaysia bank loan, the auditor will inspect the loan agreement, obtain confirmation from the bank, recalculate the interest expense, review the repayment schedule, and verify that the loan is properly presented and disclosed in the financial statement.